Hello, this is Brian Shannon from AlphaTrends.net. Today is Thursday, the 10th of July, 2008, and I'm back from vacation. And looks like all I missed was a whole bunch of volatility and slightly lower prices over the last week. The market continues to be in a terrible downtrend, with it stuck below this declining 10-day moving average here on the S&P 500. You can see that we are at lows for the year, basically. Yesterday we closed at the low for the year. Today we got a little bit back here in the S&P 500 with a 51-cent gain. But of course, this big volatility is pretty characteristic of a bear market. You tend to see a lot wider swings because there's a lot more emotion involved in a bear market than there are when prices are advancing. So, I've been saying it for quite a while, and I still believe that for most people, the best position to be in is cash right now. And if you're not comfortable in cash and you're someone who makes their living from the market, then you've got to look at the market on a very shortened time frame, because just looking at these reversals the last few days, the volatility has been amazing, and that could indicate that the big volatility and volume. If you look at the weekly time frame, this volume is really big here after about a 6 or 7 week decline. That possibly we're getting to a point that now we haven't really seen much further on the downside, that maybe this market could be setting for a turn and some sort of squeeze higher. But again, on the daily time frame, there's absolutely nothing at all bullish here. Nothing to suggest that would be coming. It's more of just one of the very small pieces of this complicated market puzzle that tells us that maybe you're just going to want to be a little less aggressive in your short sales down here, in particular since the market has come so far so fast. But objectively, we're still in a downtrend. We've got the declining 5-day moving average. We've got a little bit of resistance, looks like, at about 126 or so. But for any real upside to take hold, I think you're going to need to see it at least above this 128 level, and until it can kind of flatten out this 5-day moving average and put in a firm level of support, that's just more of a bullish hope, I guess, than anything. Because again, looking at the 10-minute time frame, we had a hugely volatile day today. Market got hit hard yesterday afternoon, came down, made new lows, big recovery, sharp sell-off, and then another recovery into the close. So when you look at it on a daily time frame, it is just from today's trading activity with a VWAP and 1 minute time frame. Big volatility all over the place. Really, just not the type of environment that favors anything but very active trading for only the most disciplined investors. I pretty much sat on the sidelines today. I'm not quite comfortable jumping back in from vacation into a market as volatile as this one. So, there'll still be stocks on an individual basis that will move from time to time to the upside, obviously. But the big picture, we've still got this lower highs and lower lows, and all these lines here that were support or resistance on the way down will likely be an area where resistance is found once again, when this market can turn itself back around. And when you get oil, looking like it broke down a couple days ago, and I think that it trapped a lot of short sellers in here once again. The trend is still clearly higher. We tested this trend line again. We've got a rising 50-day moving average, and 2 days of sideways action down in here were completely eliminated basically this afternoon, as let's go to a 10-minute time frame, as the market took out this little short-term level of resistance in this prior area in here with the 5-day moving average, and just squeezed the shorts very, very hard. So the oil continues to be a factor. Obviously, I wouldn't say that oil would be broken until it gets back below this level right here at about 107. That's where we have the 50-day moving average. That's where we have recent support as well. Below that, maybe then it makes sense to for aggressive traders to bet on the downside. But if you're in that boat, and I think a lot of people are trying to pick the top in here, it's a very, very difficult game, just like picking the low in the financials. No one's really done that successfully this year. You could say that a couple people that bought down here at 19 bucks a share, maybe they're up, but who knows if that's going to hold for another 10, 15 minutes. This is a real severe downtrend, obviously, and people will tell you that the quantitative analysts will tell you that after 5 down weeks it should do this or do that. What they should do and what they've historically done is always going to be different. History rhymes; it doesn't repeat. That's what Mark Twain said. We've got a clear downtrend here. The best bet is just to stay away from these things. They're poison. They're destroyers of equity, and there's no signs on these shorter term time frames that buyers are anywhere nearby to take control. Perhaps getting back above this level here, 2075. It was looking like maybe there was the potential for a right shoulder to be built here. Obviously, that didn't materialize. This downtrend is, pretty clear in here. We've got this downtrend line that is on the 30-minute time frame in the financials, and a little bit of resistance recently at 2075. And getting above there, maybe you get a short squeeze rally up to this downtrend line, but the trend is clearly lower. These are damaged goods. Markets correct through by price and through time. Clearly, still no signs that we've seen enough time here in this bottoming process, and obviously price has failed to make any indication that we're done going down as well. The Russell 2000 was up 65 cents today. This is a line I had drawn in previously, I guess, showing that I was thinking that it was likely to come back down towards the year lows. It does hold up above the year lows. That and the Nasdaq does, as we'll see in a minute. But we've got a declining 10, 20, 50, 200-day moving average. That's all bearish. One of the things when I was on vacation, I got a copy of the USA Today from one of the hotels, and they said that I forget what day it was, maybe 2-3 days ago, that the S&P 500 came close to being in a bear market, but missed it by 1 point. If this isn't a bear market, then I don't know what is. Forget those definitions. As I said in my book, I think the definition of a bear market is a declining 200-day moving average. We've had that since about January of this year. We're still in a bear market. There's no sign of a bottom here. To think that it's down too much, or the PE, or whatever your reason is, it's not showing up price-wise. Wait for price to confirm whatever your bullish argument may be. And again, in the S&P 500, it's not there. In the Russell 2000, it's also not there. We've got that declining 40-week moving average. These lows look inevitable to be tested and probably taken out. No reason to think that they wouldn't be. There's nothing here on the 30-minute time frame indicating otherwise. We've got the 5-day moving average maybe flattening out, but back below $66 a share. Then we test these lows and probably go down to the next level, which is found on the daily time frame near 64. So nothing bullish in here. This level at about 68 and a quarter. Getting back above there, maybe we get a little bit of a squeeze rally, but again, there's no indication. Breaking trend lines, breaking the 5-day moving average doesn't mean the market's going to turn around. It just shows that the pace of the decline has slowed, and if the market can make a higher high above this level here and add to this what might be developing into a higher low, then maybe you get a short squeeze rally. But I wouldn't be sticking around for the long side for any extended period of time when you've got such a damaged picture on so many different time frames. Odds really just continue to favor very aggressive trading. The Nasdaq 100, this market has just been chopping back and forth. Looks like we've got more resistance right about that $46 level is the important resistance. 44 and a quarter or so is the bottom end of this recent range, and these consolidations in a downtrend tend to continue in the direction of consolidations in a trend tend to continue in the direction of the primary trend. The primary trend here is clearly lower, and now we've so it wouldn't be a surprise to see this 44 and a quarter level give way at some time in the near future. On the weekly time frame, we've got a big mess in here. The only thing that you can say bullishly is that it's down so much so quick that maybe it's due for a bounce, but that's not a reason to buy. The only reason to buy is when price tells you. I'd said intraday today that possibly this market was setting up a inverted head and shoulders pattern. This kind of took that pattern out of play, but clearly the 46 level is an area where we found some recent resistance for this market, and we've got this trend line as well that hit here on the 19th and then the 25th, and again this morning. So breaking that trend line, maybe the worst is over for this little leg lower, but it's going to take a move above 46 to see any type of little squeeze develop, and if it does, possibly we could get maybe a point out of it or so, but only for very aggressive traders. If you're looking for any upside in here, I think the taking back below 44 and a quarter or so, then you're going to see the next leg lower, and the Nasdaq could still go down towards that 41 level and test those lows. So got to continue to be very cautious in here. Volatility is typically much higher in a bear market than it is a bull market, and that's what we're seeing right now.